Good afternoon, Scott Riley, T3 Live. Welcome to today's recap. It's Monday, the first day of the week, first trading day in February, and it was a harsh down day. You guys should write this down on your desk. It could always be worse. Write this down on your desk. I could lose less. Write this down on your desk. If I use discipline and honor stops and know my time frame, this movement is manageable. So with that being said, came in today after January, the market was down, just say the S&P 3.6%. We broke the accelerated uptrend, and I talked about that till I'm blue in the face. One spot to at least go from portfolio approach to some kind of tactical approach. Okay, if you didn't do it, maybe you had a few positions on verse 1770, and then we talked about how 1770 that we hit a week ago on Monday made a little floor. 4 or 5 days bouncing off. We weren't sure how much of the bounce would be. Would we have a right shoulder? Would they be able to test resistance? And what happened was today, futures were basically flat when the day opened. And in the first 30 minutes of the day, everyone had the same amount of time to make adjustments. The same amount of time to reduce risk if you had longs over the weekend or if you tried things in the first 15, 20 minutes and get short. And, be short if you want to short 177 for a continuation move after bouncing for 4 or 5 days on a key intermediate spot. So with that being said, let's just start getting into some things. So this way, you can see what the charts are saying. And if you go to the chart, you'll see here is the macro trend that is all the way down here. So if you're a macro investor, and you're holding through saying, I'm a macro investor, and you're jumping out of your skin, are you really a macro investor? Okay. If you trade intermediate trends, which most of us do, or actually the accelerated trend first, this was your shot across the bow. This was your, okay, we broke the 21-day, we broke the 8-day, which is something that I like to ride in a portfolio approach while it's intact, and then I change a little bit when it changes, and I know we got sideswiped right here, but anyway, that was your first move lower, and then all of last week, what did we do? We held here, 1772, held 1770, then even on Friday with 20 handles lower, we held 1772. So then what happened today? If we broke 772 or 1770 or 1768, which we just kept talking about, let me ask you a question. Just because people try and figure out why does technical analysis work. If you were long versus that level and we broke that level, you get out of the way because you have no idea how much deeper the correction can go. That's why it causes stops to be triggered and sellers to come in to get out of the way if they were trying it, or if they said, you know what, I'm giving it to that level. Same way, there's a lot of bears out there, right? A lot of bears that think S&P can go to 1650, 1620, 1500. So in order to get to even the 200-day, it had to break 1770 first. So maybe they got short when we broke the accelerated trend line and then watched how it reacted last week and saw that it wasn't bouncing very well, and then said, okay, now I'm going to get my continuation move through 1770 to at least get to the 150-day, the 200-day. So they start pressing, and that's why if you look back at the chart here of the SPX, you'll see this becomes that actionable pivot where anyone trying to be long versus sells, because who knows where this is going to go after a 30% move like last year, whatever. Or if you made some money short and into this first time support, usually you bounce, you covered some and said, you know what, let me let it sift out, and then you add back, there's your break. So what do we know now? We have today's low of 1739, a touch above the 150-day. Then you have the 200-day, which everyone in the world is talking about now at 1708, and then you have the macro trend line below here, and that stands at somewhere around, I would say, 1640-ish. In my humble opinion, do I think we get to the 200-day at this point? I guess it's easy to say as long as we stay below 1770, we could hit that. But what I'm doing is I'm coming in flat. I came in flat today. I bought a little spiders pre-market, a little Twitter to see what was going on. Got out. If you're on the virtual trade floor, you saw me get short the spiders around 177. Covered early as usual, 176 half-ish. If you go back, we'll go to the spiders. And then, I tried testing some things, along the way, and it didn't work. And if you look at the spiders now, this is pretty clear cut that, this trend is now broken. Okay, and that trend has not been broken with this type of decisive potency during all of 2013 that started in 2012. So this was your one spot. Okay, tight. What's happening in 2014? You know what's not happening? A move to highs here, 21-day broken, boom. And then you had this lower area, okay, that couldn't even bounce up to retest it. that broke. And you go to your 5-minute chart just to see how you could have maneuvered it. Look at the beginning of the day. Beginning of the day, you had a quick move lower. It actually even came back and retested. So if you missed this move and you were jumping out of your skin, you had too many longs on, okay, you said, okay, let me see what type of move, or if we could get a red dog reversal back above this level, and it got rejected. So if you didn't short right here, this was the spot to short, and if you don't feel comfortable shorting, once we then broke this morning low, this 10 o'clock low of, what is this, 176.51, you also could have saved yourself about 2 points. So there was definitely some things to do in this first 45 minutes if you make adjustments fast, if you had a plan, and and that's what you do. So if you go back to the weekly chart here, this does look like you have more to the downside, to be honest. So if you're trying to trade for alpha and really figure out what to do next, you could see this and perhaps this. If you're trading for daily money alpha, you hopefully got a little short here or a little short there, and maybe trade some strong stocks. But if you're on a macro sense, you still there's, if you do it every month, I would continue doing it every month. Okay, but look at this trend, and on a macro sense, this last accelerated trend kind of is broken. Okay, you saw last week on a weekly level, you have the green matched by red, traded below the weekly low of 176.89, and look where we are. Everyone's jumping out of their skin on a monthly basis, and look at the size of the move that we had. So you better really realize what you think you're trading on here. Okay, stocks are great when they ride trend lines, but then once trends break, which you look like right here, you get out of the way. And who knows, maybe we get a snapback to retest this broken trend line after getting some kind of red dog reversal, or maybe a down open to buy. We'll see. If they open them up tomorrow, traders will probably be frustrated. I know for me, I'd love to see a down open, buy some of the strong stocks, look for some red dog reversals, hammer tail bottoms, make a nice cash flow trade. If they open up 8 to 12 points tomorrow, okay, I didn't take the risk, I don't deserve to be involved. And just lastly, again, now is when all the fear mongers are going to come out. Now is everyone's going to say we're going to be down 15%, 20%, crash. If you are a macro investor and you've been buying, or just say, I'm not even go through the whole spiel. Okay, depending on your time frame, if you have 10, 20 years from now and you just survived, you survived 9/11, you survived the financial crisis, you survived the debt ceiling debate, you survived Syria, you survived all these things, you're going to survive this. Keep putting monthly flows in. If you're trading for cash flow and tactics and this and that, then you better be on your toes, because the volatility picked up, and if you reduced risk at both those inflection points, we're going to have some opportunities to move lower. With that being said, I know Goldman Sachs, stock's been very weak. Okay, you had a breakout failure up here. This is when it didn't even hold this upper level, and I know today I came in, tried to buy it, and it failed. I could have really got hurt here. I was trying to buy 165.50s. It got upgraded. I figured maybe Goldman Sachs could finally have a little bit of a bounce. Nope. So what did I do? I didn't buy the whole way down, say I'm going to be right, I'm going to be right. It went red, and I kicked it out, lost a little money. I said, that's it. But this also helped me get some clues that the financials are weak. They're still for sale. Don't be a buyer below 177. It could be a day one down, and it kept me away from buying some of the others. Citigroup had the weakest report too. And this one has been dead for sale. I talk about it on the VTF. Breakout failures we don't like. This did look good before, before the year started. Yes, and I did have it on my 2014 thesis. Broke out, failed. And what did it fail on? It failed on bad earnings. Okay, I think actually maybe, where was it? Was it down here by the time it announced? I don't remember. But either way, breakout failure, and now it's well below the 200-day. Someone last week was like, oh, should we buy Citigroup? I'm like, no, it's the weakest stock out there for now. And, well, you did have it on your 2000, okay, and the market didn't confirm it. So what do you want to do? You want to stick with it, hold your nose and go underwater, or you want to wait for a better time? And as of right now, there's still no better time. Maybe you get a red dog reversal tomorrow. We'll see. But at this point, still can't find a friend like Goldman. Bank of America does look a little bit better, but this too, if you look on a short-term basis, it was acting well, if you were playing for a breakout above this descending channel, it didn't happen, and here was your stop. And now we'll figure it out. Now we'll figure out if this support area holds. Pretty engulfing bar here, engulfed this whole area. So with the rest of the market coming in, you could see some weakness, so you want to see what happens there. Now another type of navigation, okay? During these big 15 handle point down days or 20 handles, there's been some go-to stocks There have been some stronger stocks. And typically as the correction deepens, everything gets hit. But with that being said, depends on your reason, is why you're in something. I want to talk about earnings, and I want to talk about earnings gaps. For Netflix, I know a lot of people were trading Netflix saying there was a big earnings gap. Maybe it holds. We can get continuation during this corrective phase. And if you look at Netflix, Netflix had its earnings gap. On this day, it came below. So if you had your stop there, okay, you used your stop, you honored your thesis, came back above, closed above it. Maybe you got back in a little small because you said, you know what, I can't stay with this, it's too choppy. Then on this, once it cleared the prior day's high, it became a good trade. And now for Netflix, okay, it's still in the top third of this wide range bar. If you're in Netflix thinking that it's going to hold up in the top third and it breaks below 402, then it's, maybe your thesis changed. If you're in Netflix from here and said, I'm going to stay into it as long as it stays above this earnings gap, you have a different psychology there. You look at something like people should be buying Facebook right here. I said, you know what? Facebook was a good trade on Friday, and now it's still above the earnings gap. If you're in this stock and you want to be in it, as long as it has the power of the earnings gap, you're in it. But if it happens to go below 60.17, that's your stop to lighten up, because who knows how deep it's going to go into this earnings gap. It could go below, you could lighten up, come back above like you saw in that third day in Netflix, and then you go back. By the way, that's a way to be safe during a corrective phase. In Google didn't hold its earnings gap. Okay, 2 levels we talked about this morning. I said if it's going to be healthy and get above the high of 1186, it probably should hold the pivot high of 1167. That was red flag number 1. Red flag number 2, this was your earnings gap, right? 1151. That was the spot. I think that was Friday's low. If it was going to be that strong, it should have held that. So if you're in Google all the way from 2 quarters ago, you know what? This day doesn't, you don't really care about it. But if you bought it for a continuation above the earnings high, you know what? This shouldn't have happened. That shouldn't have happened. That's why it's down here. So with that being said, we'll see what kind of range develops. Well, we know where the low is. We know 1132.01 is today's low. And we'll see if we get a red dog reversal tomorrow or not. Okay, but at this point, there are 2 flags if that's what you were playing for. And if you're playing for this trend that's been intact, then you're fine. But you have to know what you're playing it for. All right, same thing goes for just say Amazon. Amazon gave you a nice continuation. Okay, here was your, this is where it closed. This was your earnings move. Okay, it actually, played a little bit around with the prior pivot, went below 357, gave you follow through. So for traders that look for follow through, this was really good for you guys, right? Bounced around, and then market sold off. It sold off with it, and there was your day 2. Here is your big gap, not even near, and there was your follow through. As for the first time, they didn't come save it. So some traders were like, let me look for a short there. And if you've got it, congratulations. Apple talked about this 4-day range, and it seemed like it was strong. That's why we said, if it's going to hold above 506.50 for maybe 30 minutes, 60 minutes, you could try it. But if it doesn't, it's probably just in this range, and you don't want to overdo it. If you took the red dog reversal above 496.70, hopefully you sold, half of it as it was up another $3 or $4 and took the day-and-a-half trade. And in this type of market, day-and-a-half trades are hard to find. Now we know today's low, 499. If it continues to go sideways and tries to clear today's high at some point in the future, okay, if it trades below this, it could continue. Still big hole in the chart, lots of time. Maybe money was going to hide there. It didn't. Okay, but it's still in the game, and just I would say narrow your time frame down. As far as let's see, the Russell closed pretty much on the 150-day, just like the S&P. It did also break a trend line where if it doesn't reclaim the trend line quickly, you're going to see more downside. That's what you have here. Some people are always worried about if you break a trend line, it's just a way for guys out there to steal your stock. Okay, so if this was a way to get people out, get people short, it would be a trap that in 2 sessions or so, it takes it back. If it doesn't take back and hovers below it, chances are we're going to see lower prices, and look where this thing has come from. So don't just blindly buy it, because that's what worked a lot during 2012. This is now 2013. Now here was your upper channel right there that broke, and here's your 21-day that if you rode this as long as it stayed above the 21-day, this was your spot to get out of Dodge. Okay, then you have the same type of thing here. Flag, here was your pole, here's your flag, there's your continuation. So with that said, perfect bear flag, same thing as a bull flag. I personally like playing bull flags, but what's my personal likes and dislikes to be taken in the market? That's why today, I tried to be short when we broke 177. I took a little bit out of it, but that's not my type of trade. I was just happy to not be in 4, 5, 6, 12 longs because that's what happened to me when we broke the accelerated trend. So that was a different spot. Now, I'm going to try and be opportunistic. I'm going to try and jump into things, when there's a very high areas of volatility, and that could be if we open down tomorrow. Or if we open up a little bit and then they try and trade it through today's low, then maybe we get a red dog reversal. That's the kind of things that I'm looking for moving forward. Twitter still hanging around, but it still has earnings to deal with. Still, I would say in the game. I don't know where today's data is. It's not here. Actually, no, go to the daily. Not sure where Twitter's not there, but I would say if you're trading it, trade it long versus 65.37 as long as it stays above that gap. And then let's see what else was. One thing was kind of weird. Gold, right? Gold. You would have thought that it would have been making a higher high as the S&P made a lower low for 2014, but it's kind of close. I know they screwed a lot of participants here when it closed in the highs, went to the dead lows, and now it's right back in there. So, maybe this time, since everyone hates it again, it can continue. So if you want to draw this line again, here it is, and see what happens tomorrow. See if it can actually get above this, and then, and have some real traction. Couldn't do it there, doesn't mean it can't try again. At this point, I just want to say, again, the importance of knowing your time frame, importance of knowing what you can handle, and having the levels in front of you, and then honoring those levels and making decisions because it could always be worse. If you were deer in headlines when we broke the 30-minute low of 177, and you said, how could this happen? You know what? You haven't been doing your homework because that was a spot, that was an inflection point. Same way when we broke 1830, if you were deer in headlines and said, how did this happen? That was your spot. And then you're not really educated enough. You should take some more T3 Live classes, the swing trading course, the active trading course, whatever it is, or read off the charts or read the morning note. There's a lot of things that tell you every day what could happen. If this happens, then do that. If that happens, then do this. Or this is a spot to have low gross, low net. This is a compelling spot to take a stab. That's why, in the morning, everyone's, trying to play a little bit of a bounce. And I tried it and I was doing it, whatever. I'm like a 176 or 175.50. It's in no man's land. We're below the 100-day, but above the 150 and 200-day. This is just a spot to, in a trend down day, stay short or have risk off and maybe do micro scalps. And even the micro scalps weren't good. So it's Monday. It's snowing outside. I'm going to have to make my way back to New Jersey. Hopefully the roads are okay. Tomorrow's another day. Hopefully, you actually, there are some traders out there that probably made a lot of money shorting that 177. Hopefully, if you're not good at being short, at least you just got out of the way. So the volatility that's here you can embrace and then figure out other levels to wrestle with, because that's what this market's been. It's been a wrestling match, and even though the levels are there, it hasn't been easy. And hopefully, with a little bit more downside, a little bit more clarity, we're close to a nice setup, and then from there we'll see if that setup builds into a tradable low. And if not, just like you saw today, there are short setups as well, and stocks go down a heck of a lot quicker than they go up. So if you're comfortable doing that, hopefully you're making some money. Scott Redler, T3 Live. See you at the morning call tomorrow. Have a good night.